In this video, we'll examine free trade, its advantages and disadvantages. Additionally, we'll look at the relationship between investment and economic growth and take it a bit further with a discussion on multinational corporations and foreign direct investment. Generally, international trade focuses on the movement of goods and services around the world. In this video, we're going to focus specifically on free trade and consider its advantages and disadvantages. Free trade occurs when goods and services can be bought and sold between countries or subnational regions without tariffs, quotas, or other restrictions being applied. Essentially, there are no restrictions on the sale and purchase of goods and services between countries. Benefits of free trade are numerous for both the exporting country and the importing trade partner. For the importing country, they now have access to an increased number of goods and services, thus increasing consumer choice. Second, competition from abroad pushes domestic firms to increase their efficiency as business competition intensifies. Third, countries have an incentive to focus on producing products for which they have a comparative advantage and develop these specific industries. Finally, rising exports can be a significant driver of economic growth. As a country specializes, their goods and services become more desirable abroad, and the increased demand for their exports will boost local industry, create jobs, raise incomes, and lead to economic growth. However, the story of free trade would be incomplete without considering some of its costs. For domestic firms that struggle to compete against foreign competition, the loss of business can result in job losses and perhaps lead some firms to shut down and leave the industry entirely. Increased production, particularly in manufacturing, can lead to higher amounts of pollution when producing for larger market distribution. The gains of free trade are likely to benefit high-income earners and the wealthy more so than those with lower incomes and of less wealth. And finally, an infant industry, or an industry that is just beginning, may be crushed before it has a chance to develop. This is usually given as a case for protectionism. We now need to discuss investment, which focuses on business spending and how it ultimately leads to economic growth. If you pay close attention to the circular flow, you'll see that there is a close relationship between savings and investment. The market for loanable funds, or money that can be borrowed, consists of firms borrowing on the demand side and savers on the supply side. For economies with a strong banking system, they can match the deposits of savers with the borrowing needs of firms. Here, we see the equilibrium real interest rate at R star and of quantity Q star. In countries where banking systems are not as well developed or as well trusted, the disconnect can inhibit investment and limit growth potential. An economy can increase savings by increasing income and also by improving the quality of banking institutions. If savings increase in an economy, it will increase the supply of loanable funds and cause the supply curve of loanable funds to shift to the right. This results in a lower real interest rate and thus a higher quantity of loanable funds demanded. Remember, at cheaper borrowing rates, firms are more likely to borrow, and this increase in savings should lead to just that. Next is a summary of the Harrod-Domar model, which examines the relationship between increased savings and economic growth. When savings increases, this should spur on increased investment, which should increase the capital stock. When the quantity of the capital stock of an economy increases, they possess more capital with which to produce, so are capable of producing more goods and services than before. This results in economic growth, and rising economic growth leads to higher incomes, which then leads to higher savings again, and the cycle repeats. This is one of the key reasons why there is a focus for many economies to strengthen their financial systems. Now, let's look at the role of multinational corporations. A multinational corporation is an enterprise producing goods or delivering services in more than one country. A multinational corporation usually has its management headquarters in one country, considered the home country, while also operating in other countries, the host countries. Common examples of MNCs are shown here with McDonald's, BMW, and Apple. McDonald's and Apple are American companies that operate around the world, and BMW is a German company that also has operations abroad. And there are many advantages to countries that host MNCs. Let's use BMW's operations abroad to help explain some of these. If BMW sets up a factory in a new country, it will create jobs for the local economy. If many companies across various sectors are doing this, it will lead to economic growth. With that will come rising incomes for the workers, as well as the local businesses that serve these companies. The multiplier effect will increase the effect of that growth. The rise of MNCs in a country will attract investment domestically and abroad, which should spur further increases in the capital stock. As companies bring their expertise from abroad, it is likely that domestic human capital will improve as they learn new processes, technologies, and methods of production. Additionally, overseas competition in product markets should lead to greater choice for consumers. Expanding overseas also has benefits for the MNC itself. Global expansion allows access to markets that were difficult to serve before. With global sales and production, MNCs can benefit more from economies of scale. They can choose to operate in countries that have less regulated corporate environments and save on compliance costs. The MNCs may also be attracted into countries by a country's government itself by offering the MNC tax relief or subsidies to set up production there. The discussion would be incomplete without considering the disadvantages of MNCs as well. The lax regulatory environments mean that MNCs can locate in countries where they are free to pollute more or even potentially exploit the local labor force. Beyond this, if the MNC's profits are not reinvested locally and are just sent back to their home country, the benefits to the host country may be limited significantly. And the competitive pressure of some MNCs may be too much for domestic firms, and that may cause some firms to face a decline in sales or shut down entirely. As the MNC rises in influence, they may be able to exert pressure on the government to take measures in favor of the MNC, and these decisions may prioritize the MNC over the needs of the population. Now, let's look at foreign direct investment. Foreign direct investment is the category of international investment that reflects the objective of a resident entity in one economy to obtain a lasting interest in an enterprise resident in another economy. Alternatively, one could say that FDI occurs when a firm in one country purchases an interest, a long-lasting interest, in a company in another country. Let's look at the benefits of FDI to the host country. Inflows of money can boost domestic production and lead to job creation. With increased production and more people working, this will lead to economic growth as more is produced. Firms are likely to introduce technology and capital to the recipient country and share industry expertise. This will help improve the quality of capital and also the skills of the working population. Some countries require forced technology transfer in exchange for access to their market. The skills improvement should generate productivity gains and have further benefits for the economy. By now, you should have a better understanding of free trade, investment, and its relationship with growth, multinational corporations, and the concept of FDI. If you have any questions, leave them below and let's try and answer them together. That's us done for now, and I will see you in the next one.